Welcome back to the deep dive. Today we're really getting into the weeds, looking at the strategic rules for building, keeping, and sharing wealth.
Right. We're using this fascinating source material. Let's call it the rules of money.
And this isn't your typical finance advice show. We're digging deep into the mindset, the behaviors that, according to this source, really separate the truly wealthy from, well, everyone else.
That's the mission today. We're moving past the surface level pips. We're dissecting the kind of internal shift the material insists has to happen before any external actions can really stick.
Yeah.
It's about becoming the person who can handle wealth.
Yeah, the source lays it out in these 5 stages. Thinking wealthy, getting even wealthier, that's the investing bit, staying wealthy, and then sharing it.
And the structure demands the internal change first, which is interesting.
Definitely. And we're focusing hard on the specifics today, some really counterintuitive
Oh,
details.
yeah. Some rules that might, make you pause.
Yeah.
Like Rule 5, why being, well, too lazy is apparently the real blocker for most people.
Not lack of opportunity, but laziness.
Yeah.
That's stark.
It is. And Rule 35, why saving pennies like skipping your coffee won't make you rich, just miserable.
Okay, I like the sound of that one.
And Rule 55, how investing is less about spreadsheets and more like predicting the winner of a psychological beauty contest. It's quite the analogy.
Okay, this sounds like it's going to challenge some assumptions. According to this material, getting wealthy is a direct consequence of a very specific, disciplined way of thinking and acting. Let's unpack it. All right, so part 1, thinking wealthy. The source seems adamant that if this foundation isn't solid, nothing else really works. Rules 2 and 3 kick us off. Defining your destination and setting a timetable. Why is getting that specific so crucial?
Well, think about it. If you ask people, do you want to be rich? Almost everyone says yes, right?
Of course.
But then ask, okay, what does rich mean to you? Silence. Maybe one person in 100 has a number. Even fewer have a deadline.
So it's like planning a trip without knowing where you're going.
Exactly. You wouldn't drive across the country without knowing the destination, what time you're leaving, roughly when you expect to arrive. Wealthy people, according to this framework, decide the what, the when, the how. Without that clarity, you just drift. You can't measure progress.
The source uses this amazing example, almost legendary, of the wealthy friend. His definition wasn't net worth, not even the interest on his capital.
No, it was the interest on the interest, that secondary layer.
That's incredible precision.
It represents true financial independence, a system feeding itself. He knows, almost to the minute, what that compounding interest is generating.
And he measures it against, like, the cost of his lunch.
Yeah, the example is something like, if his lunch cost $50, did he earn more than $50 from that interest on interest while he was eating? If yes, he's happy. It totally reframes time and money. It's not, can I afford this? But is my capital working hard enough to cover this passively?
Wow. Okay, so the goal isn't just accumulation. It's this self-sustaining growth engine. Once you have that destination, Rule 7 says you have to purge all the baggage, the money myths we inherit.
Oh, this is huge. The psychological damage from beliefs like money's the root of all evil, or I don't deserve it, or rich people aren't happy.
Yeah, we all hear those growing up.
If you hold those deep down, you'll unconsciously sabotage yourself. You might make a great deal, then blow the profits because, it was dirty money anyway or something. It's a self-destruct button.
So the action required is what? A mental house cleaning?
Pretty much a conscious, maybe even ruthless replacement of those negative scripts. You have to affirm money is okay, wanting it is okay, and I am prepared to do the work. That last part is critical.
Which leads us straight into the reality of effort. Rules 1, 5, and 8. Rule 1 is simple. Money doesn't discriminate.
Right. It's inert, impassive, doesn't care about your background, your past mistakes. Every day is a clean slate, financially speaking.
That feels empowering. But then Rule 5 hits hard. Most people are too lazy to be wealthy. They want it, but only if it falls in their lap, like winning the lottery.
The source is pretty blunt here. It argues people confuse being busy, working hard for someone else for a wage, with working hard for themselves on the things that actually build wealth. That takes a different kind of effort, more focus, more uncertainty.
But hang on, calling it laziness, doesn't that ignore real systemic issues, like lack of access to capital, education, generational poverty? Is the source just blaming people for their circumstances?
It takes a very strong individualistic stance. It acknowledges barriers exist, sure, but it insists the response to those barriers is what matters. It argues that while systems can hinder, they don't completely prevent someone from, say, acquiring knowledge or starting small. Look at the examples often cited, Gates, Buffett, Branson. What they share isn't necessarily inherited wealth, but this almost scary capacity for focused work, doing more in a day than others do in a month. So laziness here isn't about needing rest. It's defined as the mental unwillingness to trade current comfort for future gain.
Okay, reframing it as a lack of focused application towards your own goals. That makes more sense in this context, and this connects to Rule 8. Wealth is a consequence, not a reward.
Crucial distinction. Money doesn't arrive because some committee decided you're a good person. It's the direct result, the consequence of specific actions. Hard work, yes, but also clever thinking, structuring things correctly.
The example used is the car washer charging $2,000.
Exactly. Is he getting $2,000 because he's morally superior? No. It's the consequence of identifying a niche market, ultra-rich car owners, developing a high-value service, extreme detailing, and marketing it effectively. He engineered the consequence. Most wash cars for $20. He figured out the $2,000 structure.
Right, changing the application and the audience. Makes sense. Okay, last one in this mindset section. Rule 4, keep it under your hat. Why the secrecy?
It's basically self-preservation. 4 main reasons. 1, avoid negativity. Tell people your big plans, and often those who haven't done it will find reasons why you'll fail. It protects their own comfort zone.
Yeah, misery loves company.
2, protect your ideas. Don't give away your best strategies. 3, avoid jealousy. Success breeds resentment, unfortunately.
And the 4th reason sounds a bit cynical.
It is. It's the realization that, frankly, even if you spelled out your entire plan, most people wouldn't do anything with it. They'd rather watch TV than go through the discomfort of changing their situation. So why waste your energy explaining or defending? Keep quiet. Stay focused.
Okay, mindset adjusted. Now for the practical stuff. Getting wealthy. Rule 20 says you absolutely must start with a rigorous audit. The Robinson Crusoe analogy, taking stock after the shipwreck.
Essential. And it's 2 parts. First, calculate your total net worth. That's all your assets, house value, savings, investments, pension, anything valuable, minus all your liabilities. Mortgage, loans, credit card debt, everything you owe. Get that single number.
The bottom line.
Your actual bottom line. Second, track your cash flow. Monthly or annual income versus outgoings. And split those outgoings. Fixed costs like rent or mortgage, and variable costs like food, entertainment, clothes. People often confuse high income with actual wealth. The audit cuts through that illusion fast.
And that clarity sets up Rule 22. Get finances under control.
Yeah.
Stop the leaks. Where are the biggest leaks usually found, according to the source?
3 main culprits. Unnecessary taxes, often due to poor planning. High interest payments. Credit cards are killers here. High rate loans too. And just plain negligence.
Negligence, like what?
Like letting a cheap fixed-rate mortgage deal expire and rolling onto the lender's much higher standard variable rate just because you forgot the renewal date. That's pure financial leakage.
Ouch. So how do you plug these?
Become obsessive, at least for a while. The source suggests tracking every single penny you spend for a week. See where it's actually going. The priority is then killing high-interest debt. Cut up the cards, pay them off ASAP. Stop paying others for the privilege of being in debt.
Now, Rule 23. This one's controversial. The source takes a pretty strong anti-insurance stance, which flies in the face of conventional advice. What's the logic?
It's purely mathematical and, well, cynical. Insurance companies are businesses. They exist to make profit. They use complex calculations and actuarial tables to set premiums, ensuring that, on average, they pay out significantly less in claims than they take in. The force claims most people, over a lifetime, only get back maybe 2/3 at best of what they paid in premiums.
So the house always wins, basically.
That's the argument. The odds are systematically stacked against the policyholder. That remaining third, or whatever the margin is the company's profit.
Okay, if you're losing that margin, what's the alternative strategy for handling unexpected costs, like a vet bill or a broken boiler?
The radical alternative proposed is become your own insurer. Cancel specific types of insurance, things like extended warranties, maybe pet insurance, things where claims are less frequent or catastrophic, not legally required things like home or car insurance or essential health coverage. Then take the exact amount you would have paid in premiums each month and put it into a separate, high-interest savings account or a very safe money market fund.
A personal contingency fund.
Precisely. You build your own buffer.
Okay, mathematically, I see the logic of saving that profit margin for yourself, but behaviorally, that requires incredible discipline, right? What stops someone from dipping into that fund for a holiday?
That's the absolute crux of it. The source hammers this point.
Yeah.
This only works if you have iron self-control. You must treat that pot of money as sacrosanct, only for genuine emergencies. If you lack the discipline, if you rate it for lifestyle spending, the whole strategy collapses and you're left exposed. It's high risk, high reward, behaviorally speaking.
Right. Requires certain personality type. Okay, shifting gears back to behavior rule 24. Only by looking wealthy can you become wealthy. This isn't about buying Gucci you can't afford, is it?
No, not at all. It's psychological. It's about adopting the appearance and behavior associated with success and competence. How you carry yourself, how you dress, your posture, your confidence people react to these cues unconsciously.
So it's about signaling.
Exactly. If you show up looking disorganized, needy, or like you don't care, people will treat you accordingly in negotiations, interviews, everywhere. If you project competence, power, success, even if you're not quite there yet, you command more respect, you open doors. It's like wearing the uniform of the job you want.
Right.
The scruffy candidate signals low value. The polished one commands attention.
Borrowing future respect to make current progress. Interesting. Okay, let's tackle effort versus frugality. Rule 32. Work hard, but on the right things.
Yes. You absolutely have to put in the hours. The source is clear on that, especially early on. You work hard to get rich enough not to have to work so hard later, but it's what you work hard on that matters.
Like the cleaning example.
Perfect example. The person cleaning toilets 80 hours a week, probably not getting wealthy no matter how hard they work. They need to shift their effort. Stop doing the cleaning. Start working on the business of cleaning, getting clients, hiring staff, leveraging their time. Focus effort where the return is highest, not just on being busy.
Makes sense. And then Rule 35 gives us this surprising permission slip regarding small savings. Why does the source advise against small economies?
Because, the argument goes, obsessing over tiny savings, skipping the daily coffee, walking miles to save bus fare doesn't actually move the needle much towards serious wealth. But it does make you miserable.
The cappuccino police aren't making you rich.
Exactly. It drains mental energy that should be focused on the big wins. Stopping major leaks like debt interest, structuring deals, increasing income. The psychological cost of constant deprivation can lead to burnout or resentment, which undermines the whole project. Escaping that poverty mindset, that feeling of constant lack, is more important than saving a few bucks here and there. Focus on earning more and managing the big stuff.
So strategic frugality, not obsessive scrimping. Got it. Okay, this section ends with mastering deals and negotiation. Rule 36 is key. Real wealth comes from deals, not fees.
Absolutely fundamental. Fees, wages, salaries, they're linear. You trade time for money and there's a cap. Deals, buying and selling assets, businesses, intellectual property, brokering transactions have exponential potential. That's where leverage comes in. Wealthy people are always looking for the next deal.
Rule 33 uses the Kyle McDonald story, the red paperclip guy, to illustrate deal-making.
It's a brilliant illustration of seeing hidden value and leveraging what others want. He didn't just swap items. He figured out what the other person needed or desired more than what they had, and facilitated an exchange up the value chain. It requires creativity, boldness, asking, what do I have? Skills, time, knowledge, contacts, assets that someone else values, and what can I trade it for?
Spotting the opportunity. And Rule 34 lays out how to negotiate effectively, starting with aiming for win-win.
Crucial for long-term success. You want repeat business, a good reputation. Burning bridges is bad strategy. So key negotiation tactics. Know your absolute walkaway point. Know your target price or outcome. Be flexible on small points to win the big ones.
And no assumptions.
Never assume. Discuss everything openly. What are the expectations? What's included? What isn't? Get it all on the table. And always aim high. Initially, it's easier to negotiate down than up. Be polite. Be firm. Aim for that win-win, but get the best justifiable deal for yourself.
All right, moving into scaling wealth. Getting even wealthier through investing. Rule 48 starts with a stark premise. All investment is basically a form of gambling.
It is, in the sense that there's always risk and uncertainty. The goal is to stack the odds heavily in your favor. According to the source, a true investment needs to do two things. Generate income, like dividends from stocks, rent from property, and increase in capital value over time. If it only does one, it might be speculation or just holding value, not a full investment strategy.
Which ties into Rule 56. Cut the odds by only buying what you understand.
Yes. Demystify it. If you can't explain simply how the business makes money, what its competitive advantages are, you probably shouldn't own its stock.
The Macy's example.
Right. If you shop there, see the stores are busy, like the products, you have a basic fundamental understanding. You're observing the business in action. Contrast that with buying some complex derivative or biotech stock just because someone tipped you off.
Yeah.
Understand the basics first. Avoid hype.
And that requires Rule 57. Use your head, not your heart. Easier said than done, separating emotion from money.
Very difficult. We're wired for emotion, for confirmation bias. But if the goal is purely financial gain, decisions must be based on financial merit alone, not because you like the company's mission or the houses in your favorite neighborhood.
So choosing the green company only if its financials stack up, or the investment property with the best yield, even if you wouldn't live there.
Precisely. The market rewards financial performance, efficiency, value. It doesn't care about your personal preferences or feelings. Making emotional investment decisions is a quick way to underperform.
Okay, this section has a really interesting deep dive in Rule 46, comparing long-term, tiny, regular savings versus a big lump sum invested later. The result challenges the start early, even small mantra we always hear. Let's get into the specifics.
Yeah, it's a fascinating comparison. Uses a simple 5% annual interest assumption. Scenario 1, the drip saver. Starts at age 20, saves just $10 a month, every month for 45 years.
Okay, consistent long-term, what's the total saved in the final pot?
They put in a total of $5,400 over those 45 years, $10 by 12 months by 45 years. With 5% compounding, the final amount is $21,220. Decent result from a small base.
Now, scenario 2, the lump sum saver saves nothing until age 50, then invests a single $10,000 lump sum. And that grows for just 15 years.
Right, much larger initial capital, but only a third of the investment time.
And their result after 15 years.
Their $10,000 goes to $21,819.
Wow. So the late lump sum saver ends up with more money despite starting 30 years later and investing for only 15 years.
Exactly. It's a counterintuitive result.
What's the core lesson here? It's not that saving early is bad, surely.
No. Saving early builds discipline, which is vital. But the lesson is about the power of the capital base. Compounding works exponentially faster on a larger sum. While time is important, the amount you're compounding makes a huge difference. Rule 49 backs this up. Focus on diligently building a decent chunk of capital first, then let compounding work its magic on that larger sum. $10 K over 15 years beats $5.04K over 45 years at that rate.
That really highlights the importance of generating significant capital to invest, not just relying on time alone. Okay, shifting to the stock market. Rule 55 uses Keynes's beauty contest analogy. Can you unpack that beyond the basic idea?
Sure. Keynes wasn't saying pick the objectively best company, the prettiest face. He said winning in the market is like a contest where you have to pick the face that you think the average opinion will judge to be the prettiest. It's about anticipating collective psychology.
Second level thinking. Not what I think is best, but what I think others will think is best.
Exactly. And maybe even third level, what I think others think the majority thinks. It gets complicated. It means a stock price might rise, not because the company is fundamentally amazing, but because everyone expects everyone else to buy it. Momentum, narrative, psychology become key drivers, sometimes more than just the underlying value. You have to read the room, essentially.
Which sounds tricky, so if you don't want to play that game, Rule 58 warns about hiring active fund managers to do it for you.
Yes, a strong warning based on long-term data. While some managers beat the market in any given year, consistently, over decades, most don't, especially after you factor in their high fees.
Those fees really eat into returns over time, don't they?
Massively. A 1% or 2% annual fee compounded over 20 or 30 years can consume a huge chunk of your potential gains. Plus, consistently outsmarting the entire market is just incredibly difficult.
So what's the source's recommended alternative for the average person?
Keep it simple. Keep it cheap. Use low-cost index funds or tracker funds. These just aim to replicate a market index, like the S&P 500. You get market returns minus a tiny fee, you benefit from broad diversification, and you're not paying hefty fees for likely underperformance. Passive investing wins for most people over the long run.
Makes sense. Okay, a practical tool now. Rule 80, the rule of 72 for investment turnover. How does this work?
It's a really neat mental shortcut. It helps you estimate how long it takes for an investment to double, or what rate of return you need to double it in a certain time frame. You just divide 72 by one number to get the other.
Okay, give me an example. If I want my money to double in, say, 5 years.
Okay, 72 divided by 5 years equals 14.4. You need a 14.4% average annual return.
And if an investment is returning, say, 6%?
72 divided by 6 equals 12. It'll take about 12 years to double at that rate.
How do you use this practically?
As a performance check, you set your target. Maybe you want your investments to double every 7 years, which requires roughly a 10% return, 72, 72, 7.3. If an investment is consistently delivering much less than that, the rule of 72 tells you it's sluggish. Maybe it's time to sell it and put that capital somewhere that works harder, gets you closer to your doubling goal. It enforces discipline about cutting underperformers.
Right, a quick check on whether your capital is working hard enough. Final point in the section, Rule 82, financial literacy. Why is understanding a balance sheet so critical beyond just the profit and loss statement?
Because the P&L only shows you the flow revenue in, expenses out, profit or loss over a period. It's like looking at a river. The balance sheet is a snapshot, like a photo of the river at one point in time. It shows what the company owns, assets, and what it owes, liabilities, at that specific moment. The difference is equity or net worth. Assets minus liabilities equals equity. It must balance.
And why is just looking at profit dangerous?
Because a company can show a huge profit on its P&L, but be technically bankrupt according to its balance sheet. It might have massive debts coming due that it can't pay, huge pending tax bills, or assets that are overvalued. The P&L looks great, but the balance sheet reveals the underlying weakness, the lack of solvency. Truly financially literate people know the balance sheet tells the real story of financial health and survival.
Okay, we've made it, hypothetically. Now, staying wealthy and sharing. Rule 19 brings us back to psychology. It's harder to manage yourself than your money.
Absolutely. Money just sits there. You are the variable. You have emotions, impulses, fears, temptations. Staying wealthy requires ongoing discipline, managing your own urges to overspend, panic sell, or get complacent. It takes stamina and focus, constantly managing yourself.
And that self-management needs structure. Rule 70 mandates regular financial health checks. How often and checking what?
The source recommends doing this weekly, seriously. Not just a quick glance at the bank balance either. It means properly reviewing bank statements, investment performance. Are they meeting your rule of 72 goals? Who owes you money? Who you owe money to? Reconciling credit card spending.
And watching out for taxes.
Like a hawk. Taxes are a huge liability that can sneak up on you. You need to constantly provision for them. Forgetting about a debt or a tax bill doesn't make it go away. Weekly checks enforce that awareness.
Discipline, discipline, discipline. Rule 88 adds another layer. Check the small print.
Always. Small print is rarely there to benefit you. It's usually where the traps are hidden penalty clauses, automatic renewals at higher prices, crucial exclusions in insurance, weird software licensing terms. If it's too complex or seems dodgy, the advice is simple. Walk away. It's not worth the potential headache or financial hit.
Okay, let's talk relationships and money. Always tricky. Rules 93 and 97 are very direct about lending to friends or family.
It's extremely direct. The rule is, never borrow from or lend to friends or family unless you are mentally prepared to write that money off the second it leaves your hand. Consider it a gift.
Why so absolute?
Because the relationship is almost always worth more than the money. If you lend expecting repayment and they can't or don't repay, it breeds resentment, embarrassment, guilt. It can poison the relationship permanently. You risk losing the money and the friend or family member. Just don't put yourself or them in that position if you value the relationship.
Well, what if it's not just a handout, but seed money for a legitimate business idea from someone you trust? Rule 98 offers an alternative.
Yes, a more sophisticated approach for genuine ventures.
Yeah.
The convertible loan. This is clever. Instead of just giving cash or taking equity straight away, you structure it as a formal loan. It has an interest rate, repayment terms giving you downside protection like a lender.
Okay, so it starts as debt.
Right. And here's the key.
Yeah.
It includes an option to convert that debt into equity, ownership shares, in the business if certain pre-agreed success milestones are met.
Ah, so you get the security of debt initially, but the potential upside of equity if it takes off.
Exactly. It protects your capital better than pure equity if the venture fails, but lets you share in the big success if it works. And crucially, it acts as a great filter. If the person asking for money balks at giving you a potential slice of the upside later, well, it tells you something about their seriousness or their view of your contribution.
That's a smart structure. Okay, shifting to parenting and wealth. Rule 102 has some challenging advice. Don't shield children too much from experiencing poverty.
Yeah, this one often raises eyebrows. The argument from a motivational psychology perspective is that guaranteeing wealth kills drive. If kids know a big inheritance is waiting at age 25, the source argues, they subconsciously lose the urgency, the grit, the need to strive and build something themselves.
So the advice is literally, let them think they'll be poor. That sounds quite harsh, potentially damaging.
The framing in the source is about fostering self-reliance, not about cruelty. It's not about inflicting suffering, but about allowing them to develop the hunger and resourcefulness that comes from thinking they have to make it on their own. Let them feel the need to escape that perceived future poverty and watch them develop the necessary drive.
Requires careful handling, I imagine. What practical tips does it offer for teaching financial skills?
Start early with a fixed monthly allowance. Make them budget for everything discretionary from that amount. Critically, when they inevitably run out before the month ends, don't bail them out. Let them experience the natural consequence of poor budgeting being broke for a week. That's a powerful lesson.
That's love.
Seems so. And if you plan on giving larger sums later for a house deposit or a business, the advice is to wait until they're already earning reasonably well themselves. The gift then becomes rocket fuel for their existing success, not a substitute for their own effort.
Okay. Final rule for staying wealthy, Rule 106. Once you've got it, don't flaunt it.
This is about discretion and avoiding negative attention. Ostentatious displays of wealth. The source mentions things like pink Bentleys, excessive bling, bragging about private jets tend to attract ridicule, envy, and resentment. It makes you a target.
So the club operates more quietly.
According to this material, yes. The standard is understated, tasteful, refined, keep a low profile, and absolutely never, ever tell people exactly how much you're worth or earn.
Why is revealing the number so bad?
The prediction is pretty bleak. Half the people you tell will secretly despise you for not having more, thinking you're coasting or underachieving, and the other half will bitterly resent you for having so much. You can't win. Silence is the best strategy for maintaining respect and avoiding unwanted attention or requests. #tag outro.
Wow. Okay, that was a really deep dive into a very specific, sometimes hardcore philosophy of wealth. Let's try and boil down the key actionable takeaways for listeners. 4 main points.
Sounds good. First, master your mindset. Seriously. Purge those negative money myths. See wealth as a direct consequence of specific actions, not a reward. And get crystal clear on your own definition of wealthy, maybe even down to that interest-on-interest idea. Define your destination.
Right. Second, get mechanically disciplined. Do those regular, maybe even weekly financial health checks.
Yeah.
Know your numbers inside out. Attack high-interest debt ruthlessly. And only invest in things you actually understand, using tools like the Rule of 72 to check they're working hard enough.
Third, work strategically and smart. Shift focus from just earning linear fees to making deals, leveraging assets, seeking exponential growth. In investing, lean towards simple, low-cost index funds for the core of your portfolio. And remember the power of building a substantial capital base. That's what really fuels compounding.
And fourth, cultivate discretion. Protect relationships. View loans to loved ones as gifts, or use smart structures like convertible loans for ventures. And once you achieve success, keep it quiet. Be understated. Avoid flaunting. Never reveal your numbers. Protect yourself and your peace of mind.
So those are the core actions. Which brings us to a final kind of provocative thought, stemming from the very last rule in the source, Rule 107.
Oh, what's that?
Well, after laying out over 100 rules based on hard work, logic, math, and discipline, the source acknowledges that people still look for magical shortcuts. It mentions things like, pacts with the devil, cosmic ordering, lucky crystals, even feng shui for toilet seats.
Seriously, after all that rigorous logic, why include that?
I think it's to highlight the ultimate point. If the fundamental rules are actually quite simple, work hard and smart, save diligently, invest wisely, stay focused, why do so many people ignore them and chase fantasies?
Because the simple rules are hard to do consistently.
Exactly. It underscores that the real challenge isn't knowing the rules. It's the execution. It's the day-in, day-out discipline, the willingness to do the hard, often unglamorous work. People want the outcome without the often painful process, the consequence without the effort.
So the ultimate takeaway isn't a secret formula, but the need for relentless action. Which brings us to Rule 69.
Don't just do something.
Perfect place to end. Don't just listen. Start applying these principles, even one small change, today.
Start now. Make that first move.
That's all for this deep dive. Thanks for joining us. We'll see you next time.